Hey everyone, Serge Berger here, your host of the Steady Wealth podcast. And I'm back with a list, a top three list. In this case, we're going to talk about the top three mistakes that we think are that traders do and or should be easily overcome. Um, I'm going to go into a bit more than just the top three trading mistakes. I'm going to dig a little bit deeper into a few things. Admittedly, over the past couple of years or so, I have been on a bit of a path, I guess is the best way of putting it, in terms of asset allocation for traders and trying to educate people and really make people aware of the true risks inherent in trading and investing. Because I truly believe that over the course of the past now about 13, 14 years, so basically coming out of the great financial crisis, the GFC as it's known on Wall Street, a lot of retail investors have forgotten what risk really means because there hasn't been much in terms of, broadly speaking, for risk assets as asset classes. Of course, there have been individual blowups. There will always be individual blowups, but really portfolios, as I keep repeating, U.S. equities, the S&P 500 has, for the most part, returned almost 15% per year over the past 15 years, which is, again, very unusual in the sense that it's way above the mean over the course of any given longer term period. The S&P tends to return somewhere around 8, 9, 9.5%, depending on where you look. Looking at my statistics here, that's where that falls. So the 14, maybe even 15% area over the past 12 years really has given people a lot more than they should expect over time. We feel here at the Steady Trader, as well as at Blue Marlin Advisors, our investment advisory firm, that this is likely not going to last. In fact, if you look at the past 2 years, the S&P 500 is already essentially flat over that period. We think the foreseeable future of the next 5, maybe 10 years, we're going to see the S&P 500 over the course of that time per annum on average, meaning return not much more than low single digits, so anywhere between 2 and maybe 4 or 5%. And as I keep saying, that is going to be a problem, particularly for people that are used to chart chasing the high growth stuff. And if that stuff stops working, even if there is some high growth stuff working, which of course there will be, the ability for people to pick those things is going to dramatically decrease. Therefore, a lot of self-directed traders and investors are going to dramatically underperform the market. And I know when we do surveys, I talk to our clients every day in some shape or form. What I keep seeing is complete complacency, and it is concerning, to say the very, very least. I talk about it internally to our team every day. When I hear the complacency among investors, some of those might be 40 years old, some of them 50, 60, 70, 80, almost the same in terms of complacency. Everything's good, even though there might be concern economically, they have their political motivations, whatever. They're not really taking that and implementing anything in their portfolio. They're basically long the stock market, the U.S. equity market, 85% long equities, U.S. equities, which is, if you look at it correlation-wise, I keep saying that's about 7 stocks, which is insane from a risk management perspective, particularly for people that are thinking about retiring within 5 or 10 years or are retired. To me, it honestly doesn't enter my head why people are maybe somewhat concerned about the markets, but their portfolios are an absolute tinderbox in terms of volatility. So that gets me into the top 3 things. Now, again, as I said, we're going to focus on more than just the top 3 things here. But let me start off with what I think is really by far the number one. I'm going to look at some notes here. So to me, the number one thing that people really do is they tend to treat, this is self-directed investing, they tend to treat their investing account like most of their liquid investable money outside of, let's say, real estate, trading account. And so they get lured away from someone talking about a great trade on Apple, and they forget that they should really only trade with a part of their money. And so I have a quote here that we're actually always making sure that our clients hear. So I'm just going to read this from our memo here. Basically, what we like to say is that wealth management portfolios, and wealth management portfolios just means basically a client's portfolio. That's not just their trading account, because that's only part of it. But wealth management portfolios can be divided into 2 sleeves. a strategic sleeve, and a tactical sleeve. And so the strategic sleeve is the core of the portfolio. So that typically should account, by our estimation, between 70 and 90% of assets. And then that invests in longer term horizons. Why? Because it is notoriously difficult to time the market. And again, over the past 12 years, people have completely forgotten that, the retail public, and it's going to come home to roost. I cannot be convinced of anything any more than that. And that tactical sleeve that makes up the rest of it, so let's call it 10 to 30%, is not held in the strategic sleeve, as it reads here, and it invests basically on shorter term horizons. Importantly, the tactical sleeve, which is the sleeve that most people right now are treating their entire portfolio with, that tactical sleeve allows investors to adjust portfolios and take advantage of market opportunities or mitigate emerging risks. If managed correctly, the tactical sleeve can be an important tool to improve risk-adjusted returns across market cycles. However, most portfolios overlook and utilize, in that sense, the tactical sleeve due to its smaller weight and the time-consuming nature of finding new ideas. That latter part, the time-consuming part, is what people don't have completely forgotten over the past decade. They've forgotten how difficult it is to find these ideas, and that a random trade in Apple or whatever favorite stock that reaches their inbox that doesn't go to spam and that they happen to have time to look at the minute they have time for is not a portfolio solution. So anyone that's listening to this right now, unless you are a hedge fund manager, in which case we know most hedge fund managers don't trade with all their money. They trade with, as it says here, about maybe 10 to maybe 30% of their money. The rest is in diversified portfolios. It's like literally factual, right? So make sure that you don't treat trading as your whole liquid net worth. The illusion that I get from so many people, hear this every single week when we talk to new potential clients as well. They come to us and they have this illusion, which is again a direct result of the past 12 years of markets basically going up every year, that they are going to be somehow beat every other hedge fund out there and macro time the entire market. So if you're listening to this right now and you think that's what you're going to be able to do, and maybe you are that unicorn, right? But truly, the odds are so slim that you're going to go in there and start with your entire nest egg, start to constantly micro time the market, that it's really not worth it in our estimation. So having a diversified portfolio starts with having a 70-80% allocation to what we call the strategic portfolio that is diversified. Yes, changes are being made, and then the tactical stuff is the rest. Now, the tactical portfolio, to be fair, has a really important role. And that important role is that it allows, as I said before, to smoothen the returns of the longer term portfolio. However, because most people overestimate their abilities in the markets and they've forgotten what the long-term distribution returns look like because of the past 12, 13 years, they overestimate their abilities and focus all their attention on that little 10, 20%, which unfortunately makes up like 50, 60, 70% or more of their portfolio, which is way too much, which is why they underperform the market. And again, this is coming from a trader, right? Like I'm not the passively buy and hold stuff, buy something today and look at it again in 20 years. We manage portfolios. We look at this stuff every day and do certain things. That's for a part of our portfolio. The rest is diversified, looking at market cycles, making a move every once in a while, but it's diversified and allocated. And I know right now that for a lot of people, even people listening right now, it's going straight over their head and they're saying, I don't care, because look at the markets. S&P 500 within a stone's throw of all-time highs. We had a little bit of a hiccup in 2022. Let's see where we are in a year or two, right? And let's see where we are, where every single individual investor is that right now doesn't care when the equity markets, and this is not a forecast, but it's inevitable at some point, will draw down 30, 35% S&P 500 terms, NASDAQ maybe more. It will happen. It's going to happen at the worst possible time for baby boomers. And right now, and I'm going on a tangent here, locking in some yield in the bond market is one way of being able to sidestep that, at least to some extent. In our view, that's not a recommendation, remember, but that's where we fall in this right now. So having said all that, let me bring up a chart. And this is, again, if you're listening to this on YouTube, you're going to see this. It's a static picture. If you're listening to this in the traditional podcast things where you can't see anything, don't worry. As I always say, you're not going to miss a thing here. I'm going to describe what I'm going to show in just a second. So let me quickly do that. And what you're going to see here and what I'm going to describe here in a minute is basically just what sort of it's a quad, and you have essentially what we're showing here is the difference between a professional trader called an investor and people that simply aren't taking things serious enough. So in the lower, it's four squares that are like a cube divided up into four squares. In the bottom left-hand corner, we have people that are unprofitable, but also are not stuff serious. And this is not to fix on any specific occupation, but here it says doctors, dentists, CEOs, attorneys. And I can tell you actually, and I did not make this chart to be honest with you, but factually, that is actually what we tend to see. Those kind of people don't take it serious enough. So they're unprofitable for a reason. They're unprofitable because they're just simply not taking it seriously. Now, I will tell you also, actually, most people fall into that bucket. Most people do not understand how serious this has to be taken, which is all the more reason to be more of an investor and only trade with part of the money if you're not going to take it serious. Then you have the people that are unprofitable but are serious about it. And the reason they're unprofitable is because they're taking on way too much risk and they're basically uncapitalized, undercapitalized. And then in the profitable bucket of people being very serious about being profitable, you have the professional traders. And pretty much everything in between is a thrill seeker, is someone that doesn't really take it serious. They may make some money sometimes. That's where most people fall into. Most people fall in the bucket of they may make some money sometimes. They're serious a little bit when they have time. Mostly it's when they're on vacation, which is ironic because they're somehow waiting for the market to give them something while they have time, while it's fitting their schedule, which is completely, I'm going to use moronic here, and it's not the bad mouth anyone, but it's just silly to think that way. So again, the thrill seekers too, they're not really taking it serious enough. So by them trading basically most of their money as some fun account is going to lead to serious longer-term consequences of underperforming the market. Many traders in that sense make that grave mistake of using their entire net worth for trading, or a lot of it, exposing themselves to excessive risk. And by treating their entire net worth as a trading account, it leads to portfolio blowups and much more dramatic problems down the road. Think of not being able to retire, like ever, right? Or maybe not until who knows how old. So these are mistakes that we make, all of us that are exposed to the markets. The quicker we rise up, the better. And I think it's really crucial to only trade with a part of their money available in funds that we have and ensure that the overall financial stability remains intact by diversifying. So that gets me to another point. And I think the emotions here, and under emotions, we can probably add a lot of different things under the emotional problems that people have in the market. One thing that I wrote down here is really a matter of not being patient enough. Emotions are problems as traders and investors. What does that mean? Not being patient enough. The number one thing in number two. So number one was the fact that people simply are not allocated or are overly allocated to trading as opposed to investing. Again, notice I'm not saying don't trade. We trade all the time, right? I'm just saying trade with a small part of your money and don't focus that much time on it because it's only part of your money, right? Let's also understand that. So point number two, and very important, what does that mean? Most traders get extremely emotional about things and they are not patient. So impatience to me falls under emotions. What that means is that they're not willing to let trades come to them. There is a lot of reasons to get into trades prematurely. All of them come down to one simple thing: impatience. Again, emotions, human emotions, fear and greed. People get out of positions way too prematurely as well. Trends tend to last quite a long time if they're mature enough trends. Keeping our emotions in check is important. We can take that another step further. Stop losses and preset profit targets from a trading perspective. How is that not emotions, right? So not adhering to a stop loss. And by the way, I prefer personally to put time stops on things than absolute price stops, because absolute price stops a lot of times can be meaningless. Not always, but plenty of times. So I do like the idea of focusing on time stops as much as possible. Again, you're asking yourself now, what is a time stop? Well, that depends on the time horizons you operate in. If you're operating on an intraday bucket, a time stop might be 10 minutes. It may be an hour. If you're looking at position trading, swing trading, those more tactical approaches we talked about before in a portfolio, that might be a couple of weeks. It also depends how fast an asset moves. So having some sort of a stop, whether that is mental hard stop in the market, which I know a lot of people like to do, but usually leads to really bad fills. So let me just say that. anything, any sort of worst case stop, again, time stop, having something there can really keep people from blowing up. So that would be number two, is the emotions. If we look at this a bit more of investor psychology, again, it just comes down to emotions. So the more we can keep our emotions in check, and keeping our emotions in check, and again, this is mistake number two, is a lot of that remedied by fixing number one. Again, number one is you allocating too much darn money of our net worth to trading, to the trading account. So a lot of times not adhering to stop losses or time frames or whatever, and just getting emotional about it, is because we have too much money at stake for our own purposes. So let's assume, for just random example, let's say someone has a $10,000 or $100,000 portfolio. That's their portfolio of investments, that includes IRAs or whatever. Let's say they said that they wanted to trade with $10,000. In an ideal world, that's what an investment advisor would tell them. But they are trading with, let's say, $40,000. So 40% of the money. And again, we see a lot of people doing that. In fact, most people are doing that out there. We see it's way too much. They're going to get very emotional if that 40% of their liquid investable net worth has a drawdown of 15, 20, 25, 30%. They will make a mistake even worse by selling at the worst possible time. And again, big drawdowns like that have major consequences, not only for us psychologically, but also longer term. Like, it can take a long time to make money back like that. And again, this is especially true if one is, let's say, retired with not a major income source. And even if there's a major income source, why go such a big drawdown, which may not hurt that much financially for those people that have big income in that are either still working or retired? An emotional mess up, and it's just unnecessary to do that. The third point I'd like to bring up, and this again, these all kind of flow in and out of each other. They're all the same idea. If you really dig down to it, it comes down to emotions. But a third specific thing, again, comes back down to point number one, ironically, and it really just has a lot to do with taking this thing serious, damn serious. And I've mentioned this many times to clients, and I've talked about it in speeches and presentations and podcasts and on stage and TVs and everywhere. An example of something that really was a wake-up call to me. This is a gentleman, this is probably at this point about 7 or 8 years ago, maybe more, maybe 10. And I remember the guy, he subscribed to one of our research products, and we did a trade. We closed the trade. It was a small loss. I think it was about a 2% loss. And he was new. He wrote back to us through the support team, said, "Hey, why are we closing this? Blah, blah, blah." And the explanation, of course, I wrote in the trade alert was like, "Well, we're closing it. It's not working right now. This trade, again, 2% loss, right? And we're going to try it again another point." And he wrote back, "I don't have time for stuff that has to be tried multiple times." And it was such a wake-up call to me at the time that I started to realize at what level of emotions, meaning extremity of greed, impatience, and not taking this stuff serious, most retail investors, self-directed traders are operating. However, I will also tell you, there's a remedy for this. It's called taking this shit serious. Excuse the language. And again, if we're not serious about anything, we're not going to see results. It's the same exact thing in the markets as it is at the gym or getting good at anything, right? So take it serious. If you're not willing to take it serious, don't do it, or do it with so little money, it just doesn't matter. 1%, half a percent, right? 0.2%. I don't know, whatever. Again, everyone's got different sizes of accounts and different circumstances and different risk tolerances and all that kind of stuff. But if it's going to be something that you are not willing to give appropriate time for, that you need the gentleman I told you about just now, that you need something to work and have 100% hit rates without you doing anything, it doesn't exist, right? And that's really mistake number 3. So let's summarize this quickly. Mistake number 1, by far, in my opinion, people have way too much money allocated to trading. They're treating the stock market as a trading account. Mistake number 1, by far the biggest one, and it leads to all the other problems I said. Point number 2, emotions. That leads to not hitting stop losses, not letting trades come to them. And there's a lot of people that are in the markets and have been in the markets. Some people are brand new. Some people have done this for decades, and they keep having the same problem, which is they're getting prematurely into things. They don't let trades come to them. And now, of course, one might get prematurely into a trade based on their own qualifications of the trade, which is just was then a bad trade. That happens all the time. Trust me, happens to me way more than I care to admit. That's different than just jumping into something because you read half a column on the Wall Street Journal and say that's a good idea. No research, hit the buy button. That's not a trade. That's a gamble at best. So emotions is the problem. And again, it's because most people who do that trade with too much money or have too much money in trading. And point number 3, again, just taking it serious. Take it serious. If you're not willing to take it serious, just don't do it. If you think there is going to be some auto trading program out there, there's a bunch of brokers that offer these auto trading things where you're going to follow some guru that has an amazing track record that he paper traded on. Basically, all of it was based on a couple of trades that went really well. And you think you're going to beat the pros. The odds are so small, you might as well play the lottery for the rest of your life and have bigger odds there. It's just not worth it, right? So we have to understand and come back to realistic expectations a little bit. And that's really also what this exercise is all about. It's about having realistic expectations about the stock market returns and time required to do it. If you have no time, get an investment advisor. And by the way, if you get an investment advisor, that for a lot of people, that is a really good solution to also get more tactical trading opportunities. Like, for example, what we do at Blue Marlin Advisors with our clients, like the ones that want to, we engage them from an investing and trading perspective as well. So we give them investment advisory. So we can call the clients because we know them, they're investment clients. We're already registered as an advisory firm. We can call them and say, hey, this is a good idea. Based upon your risk profile, we suggest you put X amount of money to work. We can do that for clients we can actually advise through the lens of an investment advisory firm. So for a lot of people, the newsletter format is a nice way to start, but to really take it to a better level, where they take it more serious and things get more granular, the investment advisory firm approach does make a lot of sense from a trading perspective as well. So as always, folks, I hope this was helpful. Again, the top 3 trader mistakes. And by the way, all these 3 things are easy to overcome. It's really easy in theory. It takes a bit of a nudge and a bit of coming to Jesus moment. But that's it for here right now, folks. I hope it makes sense, and we'll see you again in the next Steady Wealth podcast.